Good morning, everyone. Welcome to this NTRA National Teleconference to review federal stimulus bills recently passed to combat the impacts of the coronavirus pandemic. Today's call features an update from the NTRA and its Washington, D.C.-based federal legislative team, the Alpine Group, and a review of the federal stimulus packages and their potential impacts on equine businesses, their employees, and other individuals by Jen Shaw of Lexington, Kentucky-based Dean Dorton, one of the nation's leading experts on equine tax and accounting matters. All listeners are muted. Listeners who used WebEx to access this teleconference may submit questions through the chat icon feature that looks like a speech bubble on the right-hand side of your screen. With hundreds of participants, we will do our best to answer as many questions as possible over the next hour or so. We do have two polling questions today for those on WebEx. To access polling, you will want to click the icon with the three dots at the bottom of your screen and then select polling. The polling questions will appear in the right of your screen. A recording, transcript, and other relevant materials from today's call, including contact information for follow-up questions, will be available on the NTRA.com and DeanDorton.com websites within the next 24 hours. In addition, the NTRA has developed a COVID-19 microsite on NTRA.com that contains important information and resources for the industry. Lastly, we remind listeners to consult your advisors about your specific situation prior to making decisions based on the general guidance provided during today's webinar. I'd like to introduce the President and Chief Executive Officer of the NTRA, Alex Waldron.
Good morning. Thank you, Keith. Thank you to all of you who've joined us for this important webinar. Like virtually every industry and sport in the U.S., we in horse racing are grappling with the realities and the uncertainties brought about by the coronavirus pandemic. Thousands of businesses and individuals, from farms and racetracks to racetrack employees, horse owners, trainers, backstretch workers, and so many others, have had their lives disrupted in ways that we could not have imagined just a short time ago. Social distancing and other similar measures necessary to slow the spread of the virus have forced much of the public to stay home, and the resulting economic disruptions through ours and many others have been massive. That being said, the industry's first priority at this time must be the health and safety of our workforce and the general public at large. So, in response to the pandemic, Congress and the Trump administration have passed a series of 3 bipartisan bills aimed at combating the virus and providing emergency relief to the individuals and businesses during these uncertain times. These are not stimulus bills. These are emergency responses. Stimulus will come later, and we'll talk about that a little bit in a moment. Talking about 3 particular bills. One, we'll call it Supplemental 1, was passed on March 6th. It's the Coronavirus Preparedness and Response Supplemental Appropriations Act. This measure was the first legislative response to the virus. It's about $8.3 billion in emergency funding for federal agencies. Supplemental 2 was passed on March the 18th. It's entitled the Family First Coronavirus Response Act. This mandates 2 weeks paid leave, among other many things that are in the bill for employees. And the third, and by far the largest, was passed on March 27th, just a few days. Somebody's talking and we're hearing it. On March 27th, it's entitled the Coronavirus Aid, Relief, and Economic Security Act, so-called the CARES Act. This is the $2.2 trillion legislative proposal to bring emergency relief to sectors of the economy affected by the pandemic, including, of course, our own horse racing industry. First, this morning, we're going to hear from representatives from the Alpine Group in Washington, D.C. Greg Means is with us. He's got 2 decades of experience on Capitol Hill. The last 15, he's been the lead lobbyist for the NTRA, and he has assisted us in all sorts of matters related to the horse industry. And he's our lead on the Hill right now for this coronavirus response. Joining him will be Lauren Basil, who's been 3 years with the Alpine Group. Before that, she was the Associate Director for Government Affairs at the Center for American Progress, and she's been the Senior Tax Policy Advisor to Senator John Kerry. So with that, I'm going to turn it over first to you, Greg, and Lauren to talk to us a little bit about some of the public policy behind what we've seen in the last several weeks.
Thanks, Alex. This is Greg. Welcome to everyone. Glad to see such a large turnout, obviously. As Alex talked about, and Lauren, my colleague, feel free to jump in at any time if I'm in error or if you have something to add. As Alex said, in the last month, Congress has passed 3 bills aimed at COVID-19 or the coronavirus. The most recent one being the massive, almost $2 trillion bill. As Alex talked about, the first 3 bills have been aimed at worker protections, frontline workers, hospitals, the medical community. They have not really been industry specific at this point, with the exception of some provisions aimed at the airline industry and airline workers. But those bills have been more about, providing funding for the crisis in its current state. I'm not going to talk too much about those bills because we are going to go through. Jen's going to go through a lot of the programs and the funding and availability, and we'll talk more about those in specificity as we get to her presentation. I do want to mention, however, that now all eyes are on a 4th bill. There will be a 4th bill. In fact, the Speaker of the House had a press conference, or I think it's maybe going on currently, to talk about a 4th bill. The Trump administration has indicated support for a 4th bill. There's been a little bit of pushback from some GOP leadership about we need to wait and see how Bill 3 impacts the economy and workers and things like that. But I think everyone agrees that the design of Bill 3 is relatively short-term in nature. Despite its price tag, it was aimed to basically triage some of the current situations, so everyone understands that has a timeline on it, and that timeline will expire, but the problems are continuing to expand. In the 4th bill, there are several topics that are being looked at, already being discussed. We're already having discussions with some of our friends and allies on Capitol Hill. Everything from transportation infrastructure to create jobs, more provisions aimed at the frontline workers, hospitals, workers, unemployment. There will obviously be some corrections that will need to be made to some of the previous bills, which were fairly hastily put together in a very intense negotiating and climate in those bills at the time, trying to move speedily, which Congress is not always well equipped to do. So we do expect to revisit some of the programs and some of the issues that were in those bills as well. Keith did mention the NTRA website. There's a lot of information there that we have put together, the NTRA has put together based on some of the federal resources. So I'm going to stop there, but just understand that not only is there a Bill 4 coming, but depending on how long this pandemic continues, we expect that it will continue to get more attention from Congress. It is pretty much the only game in town in Washington, and that's getting 100% of the focus and the attention of the House and the Senate and the White House at this time. So I'll stop there to move through the program. Be happy to answer questions as we go.
Thank you, Greg. Appreciate that update. Now we're going to hear from Jen Shaw, who's a CPA, Director of Tax Services at the accounting firm of Dean Dorton. Jen is well known to many of you on this call. She currently leads the firm's equine practice, and she works extensively in our business. And she also serves as a speaker at a variety of industry events around the country. She's well versed in these matters. We haven't given her a whole lot of time to prepare for what is a voluminous 883-page CARES Act, but she's going to walk us through the 3 pieces of legislation and help us understand what's in there to help us deal with this pandemic and the economic consequences. Jen? Jen?
And to attendees for your participation. Our plan is to cover items in these 3 new laws that may be impactful. If someone could mute their line, we're getting some feedback. That may be most impactful to horse and farm owners. For each topic, I'll note who may be eligible for relief or who is required to provide benefits to employees. I want to stress that today's discussion is based on our current interpretation in consultation with others of these laws, the most recent of which was just passed last Friday. Let me stress, as Alex and Greg have both mentioned, we do not have all of the answers today. So as further guidance is issued, we will provide updates. In addition, I will remind participants to consult with your advisors about your specific situation prior to making decisions based on the general advice that we're providing to you during today's webinar. Our goal today is to provide you with information on new requirements and potential relief provisions so you may make informed decisions in connection with your advisors as you move forward during these challenging times. As Keith mentioned, you can use the chat window on WebEx at the bottom to submit questions via the chat function throughout the presentation. So here's a listing of topics I plan to discuss today. We will start with items that impact those with employees. There are some mandatory sick and family leave requirements for employers with a corresponding payroll tax credit that we'll cover. Additionally, for those employees, or for those with employees, I will discuss 2 programs which help you hold on to cash for longer or receive a credit for retaining these employees. We'll then shift to another very hot topic, the 2 different loan programs both governed by the SBA. I'll include in my comments who may be eligible for each of these programs, again, based on our current understanding, given that one of these programs is completely new as of last Friday, what the requirements are for each, and how to apply for these loans. Lastly, I'll briefly cover some of the key income tax updates that were included with the recent tax laws and guidance. So first, for those with employees, there is a new requirement for employers with less than 500 employees to provide sick and family leave to employees who meet certain criteria for leave related to COVID-19. This was included in the Emergency Paid Sick Leave Act and then the Emergency Family and Medical Leave Expansion Act. And there are corresponding tax credits that are available for paid sick and family leave. This is effective beginning today, April 1st through December 31st, 2020, and includes the following. For all employees, 2 weeks up to 80 hours of paid sick leave at the employee's regular rate of pay, where the employee is unable to work because the employee is subject to a federal, state, or local quarantine or isolation order related to COVID-19, or has been advised by a healthcare provider to self-quarantine due to COVID-19, or is experiencing COVID-19 symptoms and is seeking a medical diagnosis. This leave is limited to $511 per day and $5,110 in total over the 2-week period per employee. Or, again for all employees, 2 weeks up to 80 hours of paid sick leave at 2/3 the employee's regular rate of pay because the employee is unable to work due to caring for an individual subject to the same COVID-19 items as previously mentioned, or is caring for a child whose school or place of care is closed for reasons related to COVID-19. This is limited to $200 per day and $2,000 in total per employee over the 2-week period. In addition, employees who have been employed for at least 30 days are entitled to an additional 10 weeks of paid expanded family and medical leave at 2/3 the employee's regular rate of pay, where an employee is caring for a child whose school or place of care is closed for reasons related to COVID-19. This is limited to $200 per day and $10,000 in total per employee. So an employee who has been employed at least 30 days and is taking care of a child whose school or place of care is closed due to COVID-19 may qualify for up to 12 weeks of leave, 2 weeks sick and 10 weeks family leave, and a total of $12,000. In the materials, I've included charts that list each criteria and the corresponding leave compensation required to be paid. Some additional nuances about this program. There is an exemption available for employers of less than 50 employees if the leave requirements would jeopardize the viability of the business. The exemption only applies to leave requirements related to school closings or child care unavailability. The DOL actually just released guidance regarding what meets the standards for jeopardizing the viability of the business, and it includes things like if the amount of this expense would exceed the business revenues and cause the small business to cease operating, and other things like that. Part-time employees may also qualify. And they're entitled to leave based on the average number of work hours in a 2-week period. Additional information is available on the Department of Labor's website, and I would encourage those with questions to go there. In order to fully fund the cost to employers of this new paid required leave, there are refundable payroll credits which should offset 100% of these costs. Both the paid sick and family leave tax credits are increased to include amounts employers pay for the employee's health plan coverage while the employee is on leave, in addition to the amount paid for leave subject to the overall dollar limits previously mentioned. Equivalent credits are available for those who are self-employed and meet the leave criteria. The goal of this program is to reimburse employers for the cost of these required paid leave programs quickly, so that these credits are actually refundable payroll tax credits versus an income tax credit. The IRS has not yet issued guidance on the process for obtaining a refund, but most likely will initially be dealt with or claimed on the second quarter employer payroll tax return. So the above should be a net zero cash impact for employers and self-employed, although this paid leave requires a cash outlay before receiving the corresponding credit. Let's move on to another employer tax credit called the Employer Retention Credit. This is available for employers who either were required to fully or partially suspend operations due to COVID-19 related orders from an appropriate governmental authority, or who have gross receipts of 50% less than gross receipts in the same quarter as the prior calendar year. This is a refundable payroll tax credit computed as 50% of wages paid for the period March 13 through December 31, 2020. And up to $10,000 in wages per employee can be counted in calculating the credit amount, and health plan expenses could be treated as wages when computing the credit. If less than 100 full-time employees, then all employees are eligible when factoring in wages. The required paid leave discussed just a few minutes ago does not qualify for this credit. This could apply to trainers who have lost or who have seen a significant reduction in income potential due to reduced or canceled racing, for example. And as a reminder, this applies only to those with employees, but the credit is a permanent reduction of cash outlay. It is not required to be paid back. In addition, one very important item here, employers who receive a loan in the Paycheck Protection Program, which I'll talk about here in a little bit, are not eligible to participate or to receive the Employer Retention Credit. I'll address one more employer-specific program and then move on to the SBA loan programs. Employers and self-employed individuals may delay payment of the employer portion of Social Security tax, the 6.2%, from March 27th through December 31st of 2020. This may be deferred and paid in 2 installments, 50% due by 12/31 of 2021 and the remaining 50% by 12/31/2022. Under this tax program, the tax liability still needs to be paid, so this is a way to keep cash longer, but these taxes will eventually need to be paid. Employers who receive loan forgiveness via the Paycheck Protection Program, again to be discussed here shortly, are not eligible for this deferral. So I've covered some employer-specific requirements and benefits, some of which are also applicable to self-employed individuals, but let's shift focus a bit to address probably the hottest topics of late, the two loan programs covered by the SBA. These are both separate and distinct loan programs, and who may qualify for each could vary. After discussing both of these two loan programs, I'll walk through some specific industry participants and with some ideas about who may or may not be eligible for these, along with the employer credits I just spoke about. So the first I'm going to talk about is the Economic Injury Disaster Loan. Today I'll refer to it as the EIDL. And I apologize in advance for acronyms, but it's just easier than saying the full title every time. Those who may be eligible for these loans include those without employees, so like racing stables or racehorse owners who use third parties to care for horses, nonprofit organizations like 501c3s and 501c6s, trainers, bloodstock agents, and sales consignors. In order to qualify, you must be in a declared disaster area, so all of the U.S. currently qualifies. The SBA has had small business loan programs, including EIDL loans, for several years prior to COVID. And these EIDL loans have been in existence to address disasters, but again, recent law also increased the funding due to the COVID-19 pandemic. These loans are governed by the SBA regulations, which are completely separate from the recently passed laws. In order for a business to qualify for the EIDL loan, it must be deemed a small business, which is calculated at the standards set forth by the SBA. It's usually a function of either gross receipts or number of employees. And you typically use the NAICS code to determine what constitutes small business as defined by the SBA. And so I have an example in your materials. Under the SBA standards, racing stables, trainers, jockeys with less than $12 million of average annual gross revenue are deemed to be small businesses for purposes of the SBA loan. You do have to look to affiliates. So when you're calculating either your number of employees or your average gross receipts, you do have to look to affiliates that and affiliate is defined broadly here to include the power to control. So what are some items there where you might exercise control? If you have a greater than 50% ownership in an entity, if you have other ways to control via voting rights and that type of thing. And the exercise of control is not necessarily just the ability. So you do have to factor in your affiliated entities when you're calculating these small business provisions. For these EIDL loans, farms and those who generate at least 1/3 of gross revenue from legal gambling, which includes some racetracks, are not eligible to apply for these specific EIDL loans. Generally, business concerns do qualify, and this is defined in the not in the bill, but or in the law, but in the SBA regulations. And those include for-profit business entities, place of business within the U.S., operating primarily in the U.S., and having some type of legal form. It can be an individual proprietorship, though, as well. These EIDL loans are working capital loans of up to $2 million with long-term repayment terms, up to a maximum of 30 years. Loan proceeds may be used to repay obligations that cannot be met due to revenue losses, such as paying accounts receivable like training and board, funding payroll, paying fixed debts and monthly mortgage payments, and short-term notes may even be paid along with lines of credit. These loan proceeds, however, cannot be used to expand operations. The interest rate is limited to 3.75% for businesses and 2.75% for nonprofit organizations. And in general, if an owner of a business owns 20% or more, then the owner is generally required to personally guarantee the loan. However, the CARES Act passed on Friday only requires a personal guarantee if the loan amount exceeds $200,000. Collateral is required for all loans over $25,000, typically sought from the 20% or more owners, and collateral may be mortgage or real estate liens or a security interest in personal or business property or both of the above. In general, these EIDL loans require that the borrower attempt to obtain credit elsewhere, but this was waived as part of the CARES Act. In addition, of particular note, this EIDL program permits eligible borrowers to apply for a $10,000 emergency grant advance, which will be paid within 3 days of an application being accepted. This loan advance does not have to be repaid, unlike the remainder of the EIDL loan. So this may help cash flow in the short term, but also does not require the $10,000 to be repaid. The EIDL loans may be applied for at the SBA's website online, www.sba.gov. There are links to COVID-19 related relief along with the EIDL application. You'll need to provide items like gross revenues and operating expenses for the 12-month period prior to January 31st of 2020. Additional information to provide may include tax returns, current financials for the business, and personal financial statements for each owner that owns 20% or more of the business. Let's move on to the second separate loan protection program called the Paycheck Protection Loan Program that did not exist until last Friday's CARES Act that was signed by the President last Friday. $349 billion was allocated to fund this program, which expands the amount of loan that an employer may receive and also provides for some potential tax-free forgiveness of all or a portion of the loan. Some additional key differences versus the EIDL program I just discussed. Number one, this is available to businesses with 500 employees or less, unlike other EIDL loans, which are a function of number of employees or gross receipts depending on industry. Also, it is applicable for self-employed individuals. Given the language included with the CARES Act that notes any business concern, it is our current belief that specific businesses not eligible for the EIDL loans, like farms and racetracks that generate more than 1/3 of their revenue from gambling, should qualify for these PPL loans if they have 500 employees or less. But the SBA could certainly take a more restrictive position than our current belief and not include farms in these gambling facilities. However, the PPL program application issued yesterday does not make mention of specifically excluding these entities. Greg, do you want to just briefly discuss from a legislative perspective?
Yes. So as I mentioned earlier, these bills are fairly hastily put together, and they're using the Small Business Administration as a vehicle, which is typically not what they do. So that's something new. There does appear to be some what we would view as archaic underlying regulatory language at the Small Business Administration that has some restrictions for certain entities that derive some of their revenue from gaming. We think that's an old regulation. We're still trying to get to the bottom of it. I have another meeting with SBA this afternoon. We would like to eliminate any type of restriction to reflect kind of the 2020 economy and not an economy from decades or years ago. That's, as I mentioned, in Bill 4, there will be a lot of corrections, technical corrections, and clarifications. If the SBA if this definition, which I don't like it because it's residual and should not be there, we will try to get that eliminated. In the meantime, we have some of our friends and allies on Capitol Hill who are actively talking to the SBA administrator and the staff at SBA, as well as Secretary of Treasury Mnuchin and the Treasury staff, since they're involved in this as well. We're trying to A, better understand it, but B, also trying to make sure, look, the intent of Congress with this broad-based $2 trillion bill was to get money into employees' hands, to help small businesses, to help other businesses, Clearly, the intent of Congress was not to have rules and restrictions that were too onerous or specified industries. So it's a work in progress, to say the least. But we feel, going forward, we need to clarify or have eliminated some of these guidelines, which are not helpful for our industry.
Greg, to be clear, this is Alex. That applies to farms as well. We're looking not only at restrictions on entities which derive more than 1/3 of their revenue from gambling, but also to farms, our farm agricultural enterprises. There's some confusing language that we referred to both under the EIDL and the PPL programs. We're going to be looking at that as well and trying to get that removed as well. Correct?
Yeah, that's right. And in addition to that, I think that, what we're coming to understand is maybe the reason that has been in there has been because the SBA has typically not been, aimed at farms and agricultural operations. That's typically been kind of an element of the U.S. Department of Agriculture. So we are in some discussions with some of our friends at USDA trying to understand if they have some programs that might be available that might get boost in funding for this as well. So it may be I think that's the rationale for why that's there. But if they're going to funnel all this money through the SBA, then they need to get rid of that restriction as well.
Jen?
Oh, yes. So thanks, Greg and Alex, for talking about the legislative side of things. And I want to point out that in addition to farms and facilities that generate revenue from more than 1/3 of the revenue from legal gambling, 501c3s and 501c19 nonprofit organizations were specifically included in this PPL program, but other 501c entities like the C5s or C6s were not specifically included at this point. So I just wanted to point that out, and obviously Greg and Alex are well aware of that as well. Some additional requirements as it relates to this program. There's no personal guarantee and no collateral. So I talked about the EIDL program where there's a potential for that, but there's no personal guarantee, no collateral. The loan terms were just announced by Treasury yesterday, so hot off the presses. It's a 2-year loan at 0.5% interest, with the first payment due 6 months from the date of the loan, and interest will accrue over that period. There is a deferral of payment of the first payment for 6 months, and the loans may alternatively be prepaid without penalty. The maximum loan amount is calculated by taking the average total monthly payments for payroll costs during calendar year 2019 times 2.5, limited to $10 million total. Seasonal employers will use a different period, either a start date of February 15, 2019 or March 1st, 2019 through June 30, 2019 as the relevant time period. We've had some questions come through as it relates to how self-employed individuals calculate this test. And based on guidance issued, it's a function of net earnings from self-employment up to $100,000. The eligible payroll costs paid to employees, including salaries, wages, commissions, or other similar compensation, are limited to up to $100,000 per year per employee to qualify. Payment of vacation or sick leave, group health care benefits, including insurance premiums, and payment of retirement benefits. Again, as I mentioned, self-employed individuals include the net earnings from self-employment up to $100,000. The credit available elsewhere requirement of SBA loans is waived. So this means that owners of businesses are not required to seek other sources of capital, including equity or debt investments from the owners prior to obtaining a loan. Borrowers, though, however, must, and this first one is key, borrowers must certify, and it's a good faith certification, that the uncertainty of current economic conditions makes the loan necessary to support the ongoing operations of the business. that funds will be used to retain workers and maintain payroll or make mortgage payments, lease payments, and utility payments, and the business that has not received amounts from the SBA for the same purpose and duplicative of the amounts applied for. This application is signed by and certified by each owner with an interest of 20% or greater and the business entity itself. There are some special affiliation rules that are waived for hospitality and restaurant industries, which I mention here because I know that some horse owners also participate in different industries. The allowable uses for these loans relate to payroll costs and then interest on pre-existing mortgages, pre-existing rent payments, utilities, and other interests. Applications for the PPL program will be handled through SBA-approved banks versus the SBA directly. Yesterday, this application was released by Treasury along with some facts. If you have not already done so and believe you may qualify, I would recommend contacting your bank. Businesses and sole proprietors may begin applying for these PPL loans April the 3rd, and independent contractors and self-employed individuals may apply April the 10th. Additional information is available at treasury.gov/cares. The biggest benefit to these PPL loans is the potential for tax-free forgiveness of all or some of the loan. The forgiveness amount is calculated based on the use of funds and employee retention and is available for up to 8 weeks of qualifying costs paid for payroll, mortgage interest or rent, and utilities. The 8-week period begins when the loan proceeds are received. If consistent employee levels are maintained and also applied to qualifying costs for rent, mortgage, and utilities, then the PPL loan proceeds should qualify for forgiveness. However, Treasury announced yesterday that qualifying non-payroll costs such as rent, mortgage interest, or utilities, which exceed over 25% of the total loan, are unlikely to be forgiven due to the anticipated high number of applicants. The ability to have at least a portion of the loan amount forgiven and the relaxing of some of the normal SBA qualifications for loans make the PPL program attractive to those who qualify. Since this is a function of wages paid and or self-employment income, it is only available to those who have employees or who generate self-employment income. So I thought it'd be good, after talking about all these programs, to just walk through a couple of different industry participants and see what types of credits or deferrals or loan programs may apply for each of these areas. So let's talk about racehorse owners or racing stables that have no payroll. And that's pretty typical for these entities who hire third parties like trainers and boarding farms to take care of the horses. So I said might be eligible or may be eligible for an EIDL because, again, anything else is payroll related. So in this case, a racehorse owner or racing stable with no payroll would probably want to look at an EIDL, and if average gross revenues, remember again, if they meet the criteria otherwise, are less than the $12 million. There is a chance where if this is a sole proprietor with net self-employment income, that there may be some opportunities for the PPL, but in general, for most in this space, you'd be looking at the EIDL since no payroll. On the flip side, a trainer who does have employees on staff, since they're employing people, the trainer may be eligible for really any of these programs, depending if criteria are met. And again, if you do the PPL, the payroll or the Paycheck Protection Program loans, you're not eligible for some of the employer tax credits or employer tax deferrals. We talked about the ambiguity as it surrounds horse farms right now. Again, based on our current interpretation and what we think is the intent and the language in the bill that includes any business concern, may be eligible for horse farms may be eligible for these PPLs or the employer tax credits and employer tax deferrals. Again, you have to pick one or the other. They are not specifically eligible for EIDL loans. We do know that. On the bloodstock agent, so I try to incorporate here consultants. So bloodstock agents, consignors, managers of racing stables that operate as a sole proprietor or partnership without any payroll. So typically these entities receive commissions type income. So because they're a sole proprietor or partnership, they may be eligible for the PPL based on self-employment income up to $100,000 per owner, or they can do an EIDL, which could be converted into a PPL, and then they can do the employer tax credits and the employer tax deferrals on the self-employment income generated via the sole proprietorship or partnership. It's a mouthful. On the flip side, if you've got the same types of folks who operate as an S corporation, and typically you would operate as an S corporation to reduce your exposure to self-employment tax, and S corporations require that you pay wages that are reasonable. So the typical scenario we have here is that you've got an S corporation that only pays shareholder wages. So in this situation, you may be eligible, the entity may be eligible for a PPL based on wages paid to the shareholder of up to $100,000. Or you could do the EIDL again, or the employer tax credits, but you wouldn't look at the full income. You would look at the shareholder wages only, limited again to the $100,000. If you're a 501c3 nonprofit entity that has payroll, you may be eligible for all of these items, again, subject to the limitation that if you do the PPL, then you cannot do the employer tax credits and employer tax deferrals. And then, as I briefly alluded to before, the 501c6 nonprofit entity with payroll, they are eligible for the EIDLs as it stands, the employer tax credits and the employer deferrals, but based on the current read of the CARES Act as it was passed currently, they may not be eligible for the PPL. So what I'd like to say here is just in general, if you have payroll or you're self-employed, I would recommend comparing the PPL program versus the employer retention tax credit to see which may provide the larger tax benefit, since both may reduce the overall cash out of pocket. For those without payroll and without self-employment income, consider the EIDL program, which may offer up to $10,000 of advance that is not required to be paid back. So just lastly here, I'd like to briefly cover a few of the more pertinent income tax provisions included with the recent laws. By now, many of you know that the April 15th federal tax filing deadline has been deferred until June 15th. This deferral also includes federal tax payments due on April 15th, so any 2019 balances due and 2020 first quarter federal tax estimated payments are now due by July 15th. And with all these new laws passed, it's probably a good thing because your CPA is probably fully consumed with helping you navigate all of these new relief provisions and requirements in these challenging times. Each state is addressing this delayed filing deadline separately, so please check with your respective states in which you file to confirm updated due dates. The focus of the tax changes included in the recent laws basically is to get cash in taxpayers' hands as quickly as possible, so many of these are at least temporarily favorable for equine industry participants. The first one is something I've talked about extensively since it was enacted and included in tax reform in late 2017. It did actually affect many in the horse business. It's not horse business specific, so it does have an impact on many horse and farm owners, particularly those who use some of that 100% bonus depreciation and other tax incentives to accelerate tax losses. So effective beginning in 2018 under old law, per year, there was a limitation on net business income that could be claimed. For 2018, it was $250,000, or it was $500,000 if you filed a joint return. 2019, it was scheduled to be $255,000 or $510,000. So that means you are currently limited to only claiming that amount of net business loss against your other taxable income, which was a significant change from prior law. So as part of the CARES Act, this provision is deferred until 2021. So the good news is that those who have been subject to this limitation or would have been subject to this limitation are no longer, the limitation no longer applies for 2018, 2019, and 2020. So for those who were originally subject to this limitation when they filed their individual returns in 2018, you can go back and amend to request a refund. And this limitation only applies to individuals, trusts, and estates, non-C corporate entities. That's the good news. The bad news is that when this comes back into play in 2021, wages are no longer considered business income for purposes of this calculation. But again, this is significant dollars for some that does help to put cash in your pocket. There's some net operating loss rules that expand the carryback provisions. So for net operating losses generated in 2018, 2019, and 2020, these may now be carried back for up to 5 years and fully offset taxable income. They, under prior law, as part of tax reform, they were available for carry forward only in general and could offset up to 80% of taxable income. And this applies to C corporations and the net business losses generated by individuals, so both qualify. Charitable contributions, 2020 cash contributions made to qualifying charities but not donor-advised funds or private foundations. Individuals may offset 100% of their income with these qualifying cash contributions made in 2020. The normal 60% of adjusted gross income limitation is temporarily removed for 2020 only. And again, the whole idea is to incentivize people to get cash in operating foundation, or excuse me, operating entities and charities, so that the charity can use that during these difficult times. For C corporation, you may offset up to 25% of income versus the normal 10% limitation. I'll just briefly make mention from retirement plans and IRA distributions. RMDs, required minimum distributions, are waived during 2020. The idea there is that instead of having to take a distribution while your portfolio is in a loss position, you're not required to do so. And there are some certain withdrawal rules that or provisions that may be used if you need to use funds from your IRA or qualified plans for COVID-19 related purposes. The taxability for those is beyond the scope today. And then last, I'll just leave with the qualified improvement property. This was another hot button topic, and there was a technical error in the 2017 federal tax reform. This fixed the glitch, if you will, and so now this property is eligible for the 100% bonus retroactive back to 2018. So if that applied to you, you can use that to request a refund on an amended 2018 return.
Jen, you have done yeoman's task here today. I really appreciate you answering all these questions on the fly. These are complicated rules that we're trying to decipher here on really a short turnaround. So I thank you for that. Greg, is there anything you'd like to add to Jen's comments for the remainder?
No, I think I agree. Great job, Jen. A lot of details, and just, would ask everyone, bear with us. This is, I've been in Washington for a long time, been through a lot of crises. I've never encountered anything quite like this. So, it's being done on it's going to continue. We're going to continue to advocate for those types of things that will help the industry and help the employees and all of you on the call. So just bear with us and bear with Washington. And we'll keep going.
Well, I think too, Greg, it's important to say this has been instructive to us as we prepare for round 4. We go back to Washington for additional emergency relief. We know that there's some gaps that relate to our industry that we need to see if we can fill for people who right now aren't seeing any relief. And I'm not just talking about farms and racetracks. I'm talking about others as well. This has been very helpful to us.
Absolutely.
Keith, I'm going to turn it over to you and let you close it up.
Thanks very much, everybody. We'll have a transcript and a recording of the teleconference up on the Dean Dorton and NTRA websites by tomorrow, this time tomorrow. And we also will try to summarize many of the questions and put those up on the website as well, along with Jen's PowerPoint that she took us through today. Thanks again. We had just over 500 participants, and appreciate everybody's involvement, and look forward to doing this again in the near future.
Hey, Keith.
Yes.
One last point. Jen, are we going to be putting up some specific documents that will walk people through the specifics here as well?
Yes. So in the coming days and week, what we plan to do is do a summary one-pager that will link to further specifics, because it's obviously difficult to address all the criteria and all the nuances of these in a 1.5-hour webinar. So the plan is to get that out sometime within the next week or so, and be available to industry participants.
Okay, thanks, Gene. Jen,
We'll
that'd be
add
great.
those to our COVID-19 microsite on NTRA.com, as well as on the Dean Dorton site, Alex. So they'll be on both locations.
Yep. Gotcha. Okay.
Thanks, everybody.